Bitcoin is wild, it's volatile, it's unpredictable. But what if I told you that's exactly what makes it valuable? Not as a get-rich-quick scheme, but as a powerful tool inside a traditional investment portfolio. This is the story of how Bitcoin, yes, Bitcoin, can actually make your portfolio stronger, not riskier. Let's break down the truth behind volatility correlation and how smart investors are using Bitcoin to gain an edge. Bitcoin's volatility is legendary. It can soar 30% in a week, then drop just as fast. To most people, that screams danger. But in the world of portfolio design, volatility, when used strategically, isn't something to fear. It's something to leverage. Think of it like fire. It can burn you, yes, but controlled properly, it powers cities. That's Bitcoin in a portfolio. It doesn't need to be your centerpiece. But a small slice, just 1 to 3%, can ignite serious performance when held long enough. The truth is, Bitcoin doesn't always increase your risk. It can reduce it if you know how to balance it. Because Bitcoin doesn't move like other assets. It lives on its own timeline, and that's the edge. In traditional markets, most assets are chained together. Stocks go up, bonds go down, bonds rise, gold responds. But Bitcoin, it refuses to play by the rules. It has low correlation to everything, stocks, bonds, even gold. That makes it unique, that makes it valuable. Because when the market dips, you don't want more of the same. You want something different. Bitcoin zigzags while others zag. It doesn't follow Wall Street's calendar. It runs on network effects, global adoption, and scarcity. Adding something that behaves differently means your portfolio breathes easier during turbulence. It adds a layer of protection, even if it doesn't look like protection. Here's the magic. You don't need to go all in. In fact, you shouldn't. What makes Bitcoin so powerful isn't a massive investment, it's that a tiny allocation can do serious work. Just 1 to 3% of your portfolio in Bitcoin has historically improved total returns while reducing overall drawdowns. That's not hype, that's data. It's what we call an asymmetric bet. You risk a little, but your upside is massive. If Bitcoin succeeds, that small piece balloons. If it fails, your downside is capped and you rebalance back. You're not betting the house, you're adding rocket fuel to a stable engine. Rebalancing is your best friend. It's the move that keeps Bitcoin from overwhelming your portfolio or, disappearing into dust. Here's how it works. You set a target, say 2%. If Bitcoin jumps to 5%, you sell the excess and redistribute. If it crashes and falls below 1%, you buy more, automatically without emotion. This turns volatility into opportunity. You're not reacting to price swings emotionally. You're actually using them to enhance returns. And with Bitcoin, those swings come often. So rebalancing isn't just smart, it's essential. It turns chaos into strategy. Let's talk about psychology. Because honestly, Bitcoin will test you. There will be headlines, there will be crashes, people will scream it's over, and then, without warning, it'll rally to all-time highs. The biggest gains in Bitcoin didn't come from perfect timing. They came from holding through hell. That's what we call behavioral alpha, the edge you get when you don't flinch, when you trust your strategy, when you ignore the noise. Bitcoin isn't just about code, it's about conviction, and if you hold it right, it might just change your life. The old model is dying. The classic 60-40 stock-bond portfolio isn't built for a world of inflation, currency debasement, and digital assets. It needs an upgrade. And that upgrade could be Bitcoin. Even just 1%, yes, 1% can increase performance, reduce drawdowns, and boost Sharpe ratios in backtests going back a decade. Bitcoin isn't a replacement, it's an evolution. It's the third pillar, stocks, bonds, scarcity. And when you blend all three, you don't just invest in the past, you prepare for the future. So how do you actually do this? How do you add Bitcoin to your life without gambling or guessing? Start with education. Know what Bitcoin is. A decentralized, fixed supply, censorship-resistant asset. Then choose a platform with strong security, like Coinbase, Kraken, or Swan. Set up recurring buys, weekly or monthly. Don't try to time the market, just dollar cost average in. Move your Bitcoin off the exchange into a cold wallet like Ledger or Trezor, and then, step back. Don't watch the price every day. Set your allocation. Stick to your rules. Rebalance quarterly. Hold through storms. Most of all, remember this. Bitcoin isn't just a volatile digital coin. It's an idea, a system, a hedge, a weapon in your portfolio toolkit. Use it wisely and it could be your unfair advantage. If this opened your mind, hit like, subscribe, and share it with someone who still thinks Bitcoin is just a gamble. You don't have to believe the hype, but you should understand the strategy. Because the future of investing isn't just about stocks and bonds anymore, it's about freedom, scarcity, and owning your edge. This is Web3 exclusive, and this was the Uncorrelated Edge. See you in the next video.